When you think about inventory, you probably just picture boxes stacked up on a shelf, right? But what if I told you that one mistake with those boxes could cause a company serious, multi-year financial damage? So let's dig into how that happens.
I mean, really think about that. How can one simple miscount in a warehouse spiral into a financial mess that takes years to untangle? Well, the consequences are absolutely massive, and it's all because of one single, really powerful concept.
It all comes down to what we call a ripple effect. One little mistake doesn't just stay in one place. It actually spreads kind of like a virus, and it poisons a company's financial statements for years to come. Getting this is the key to understanding why inventory accuracy is so critical.
Okay, so this diagram right here, it's the perfect roadmap of the chaos I'm talking about. You can literally see the financial dominoes falling one after another, all from a single mistake. Let's follow the chain, starting with year one.
So let's say in year one, you count too much inventory. On paper, it looks like you sold less stuff than you really did. This makes your cost of goods sold seem lower, which, hey, makes your net income look fantastic, way better than it actually is. And at the same time, on the balance sheet, your assets look inflated. It's basically a house of cards, just waiting for a breeze.
And this is where it gets really messy. That mistake doesn't just disappear. As this source points out, it literally flips on its head. The overstated ending inventory from year one automatically becomes the overstated beginning inventory for year two. Now all the math is skewed in the opposite direction, and it causes that year's net income to be understated. So boom, one mistake has now distorted 2 full years of financial results.
So the big question is, how do companies stop this financial chaos before it starts? Well, they rely on two main systems. You can think of them as two guardians, if you will, that keep watch over their inventory. Let's break down how they work.
On one side, you've got the perpetual system. Picture a hawk constantly circling, watching every single item and updating the records with every single purchase and sale in real time. Then you've got the periodic system. This is more like a farmer who just checks the fields every now and then, maybe at the end of the season, to see what's left. One is precise and pricey, the other is simpler but gives you way less detailed day-to-day.
Now, if we dive a little deeper into that perpetual system, its power is pretty obvious, right? You get a constant, up-to-the-minute view of everything you own. This is perfect for businesses that sell high-value things like cars or expensive jewelry, where you absolutely need to know exactly what's on hand. The catch? Well, all that amazing real-time data doesn't come cheap. It's way more complex and expensive to run.
Okay, so you might be thinking, great, a fancy high-tech perpetual system means I can just kick back and never count boxes again, right? Well, not so fast. Turns out both systems eventually lead to the same time-honored tradition, the physical count. And here's the bottom line. You still have to count your stuff, period. For a company using that fancy perpetual system, the count is a critical checkup. It's how they spot errors or even theft. But for a company on the periodic system, this physical count isn't just a checkup, it's everything. It is the only way they figure out their inventory for the entire year.
All right, so counting the boxes you can actually see in your warehouse, that's one thing. But what about all the stuff that's not there? Goods on a truck halfway across the country, or products sitting in a partner store. This is where the rules of ownership get super important.
The first tricky spot is what we call goods in transit, and it all comes down to 3 little letters, FOB. You'll see terms like FOB shipping point or FOB destination. It stands for free on board. And trust me, this is the magic key that tells you the exact moment that ownership of those goods transfers from the seller to the buyer.
Let's make this really simple. If the contract says FOB shipping point, the second those goods leave the seller's loading dock and are on the truck, they belong to the buyer. The buyer has to include them in their inventory count, even if they won't physically see them for another week.
Now, flip that. If the terms are FOB destination, it's the total opposite. The seller owns those goods and is responsible for them for the entire journey, right up until the moment they're dropped off at the buyer's door. So while that shipment's on the road, it stays on the seller's books.
Another common curveball you'll see is consignment. This is where one company, the consignor, sends its goods to another business, the consignee, to sell for them. The rule here is actually super straightforward. The inventory always belongs to the original owner, the consignor, until a final customer buys it. The consignee is just holding it. It should never, ever show up on their balance sheet as an asset.
Okay, that was a lot to take in, I know. So how about a quick pop quiz to see if it's all sinking in? Let's try a couple of questions that come right from our source material here.
Here's the first one.
Let's say a company buys some goods, but they forget to record the purchase. And then they also forget to include those same goods in their ending inventory count. What's the impact on the financial statements? Go ahead and pause here if you want to really think about it.
And the answer is D. Kind of wild, right? This is that classic accounting scenario where two wrongs actually make a right, at least on paper. Because the purchase wasn't recorded, the goods available for sale is understated. But since it was also left out of the ending inventory, the final cost of goods sold calculation ends up being correct. The two mistakes just perfectly cancel each other out.
Okay, last one. This time, a company's ending inventory was miscounted. The true amount of inventory they have is actually higher than what they recorded on their report. So what effect does that have?
The answer is B. And this brings us right back to that ripple effect we talked about at the very beginning. If the company recorded less inventory than it really has, the books think that more stuff was sold than actually was. This makes the cost of goods sold number too high, which in turn makes the company's profits look lower than they really are. See how it all connects?
All right, last big piece of the puzzle here. Let's talk about what all this stuff is actually worth. When a company puts a value on its inventory, you might think it's just what they paid for the items. But the true cost that goes on the books is actually a lot bigger than that.
See, the cost basis includes almost everything it takes to get a product from the supplier onto the shelf and ready to sell. We're talking the purchase price, yeah, but also things like shipping costs to get it to the warehouse, any import taxes, handling fees, even insurance while it's in transit. All these costs get bundled together into the value of that inventory asset on the balance sheet.
So when you get right down to it, inventory isn't just stuff. Not at all. It's the lifeblood of a business. It's this dynamic, really complex asset that tells a deep story about a company's efficiency, its financial health, and sometimes even its honesty. So the next time you're looking at a company's financials, don't just glance at that inventory number. Ask yourself, what's the real story that number is trying to tell me?